Welcome to another in our series of timely webinar topics for the CIRA industry, the Common Interest Realty Association industry. Tonight's program is on income and sales tax, the road through or around the code, and we hope you find it informative. I'm Ed Guttenplan, Managing Shareholder at Wilkin & Guttenplan, and I will be moderating tonight's panel, which includes Carol Karansky, CPA, MBA, Senior Manager with Wilkin & Guttenplan, and has been with the firm for 17 years. And Vinay Navani, CPA, MBA, and MST. He has the most letters, so we put him last. And he is the head of our tax department who often consults with our community association practice as it relates to tax matters. So the rules for tonight are as follows. You can email us your questions, observations, technical issues, or comments, and we will either insert the questions as we go where relevant. We will try to address them at the end if there is time, and if not, you can always feel free to email any of us directly here at the firm, or we'll try to attend to some of the email questions at the conclusion of the session or afterwards. Tonight we're also going to have some polling questions to see how our audience responds to some of the technical questions. When the polling question comes up, as quickly as you can, please identify your answer by clicking on the answer of your choice, and do it quickly so we can move the program along. And after a short period of time, we'll display the answers to the polling questions and move the program along. Again, if you have any other questions, you can email us as we go. We will be putting the webinar up on our website after its completion. I'm not sure exactly the timing, but it will be soon. It will be up on our webinar if you want to see it again, or one of your fellow board members or property managers wants to see it as well. Finally, mark your calendars for Thursday, December 9th. We will be presenting another webinar on clubs. This program was originally scheduled for the summer and has been rescheduled for December 9th, which includes panelists who presented this program at the CAI National Law Conference and the CAI National Conference. And the speakers include Dave Ramsey, Jen Lowiak, Deb Pasquarello, and myself. This program will be an eye-opener for those of you who have clubs and committee activities, and we hope to help answer some questions. So that's my role. I'm going to moderate. I'll jump in where I need to. But without further ado, I'm going to turn the program over to our first speaker, Carol Karansky.
Good night, good evening, everybody. First, I want to go through what we're going to cover tonight. We're going to cover federal taxes, state taxes, sales and use tax, capital improvements, energy credits, and 1099 reporting. In general, all CIRAS are taxed as corporations. Just before we go a little further, I want to make sure everyone understands. We use the acronym CIRAS throughout our seminar tonight, and CIRAS stands for Common Interest Realty Association, and that encompasses condominiums, homeowner associations, cooperatives, and timeshares. Tonight's webinar will cover federal taxes for condominium and homeowner associations only. We will not be talking about the tax laws regarding co-ops, as they're a little bit more complex, more than we can cover tonight. However, if you'd like us to present a webinar on co-op, please email us, and we'll be happy to look into presenting one. Before we go any further, we'd like to have an idea of who makes up our audience. So, polling question. And what is your role? You can see that up in the corner, so if you can answer that, that would be great.
While you're answering the questions, if you do have an email, there's a place on the right-hand bottom section of the screen to type in your email question. So you can type it in down there. If you feel you want to do it at another time or offline, you can email us directly at wgcpas.com.
Okay. All right. So it looks like most people attending are board members. We also have some property managers and then some others. So we have an idea of who our audience is, primarily looking like a number of board members are listening, which is great.
And the attorneys know the answers, so they didn't respond.
All right. CIRAS, for the most part, are not tax exempt. Although they're not-for-profit, they're not tax exempt in the eyes of the IRS. The IRS has determined that to qualify for tax exempt status, they must serve the community. And generally, associations serve their members, but not the community at large. Some background on federal taxes. Originally, way back, CIRAS all had to file as regular corporations. They were just taxed on the excess, if any, of income over expenses. Then in 1969, Section 277 of the Internal Revenue Code was added to require segregation of membership income versus non-membership income. And this was done primarily to prevent any offsetting of membership losses against taxable non-membership related income. Then in 1976, Internal Revenue Code Section 528 was added, and that was done really to provide CIRAS with two benefits. One is they wanted to simplify the method of filing. Form 1120 is a complicated form, a number of pages, and a lot of schedules. They wanted to simplify it and give CIRAS a much easier methodology for filing. Also, they introduced the concept of exempt function income, and the fact that exempt function income would be income that would not be taxed. And the intent of Congress in doing this was so that CIRAS would receive the same benefit and suffer no penalty as compared to individual homeowners. They'd be allowed to build up reserves without tax consequences, and the association would pay rates similar to what individual homeowners pay. So basically, under those sections in the code, you really have two options for how to file your tax return. You can file as a regular corporation under Section 277. You'd use Form 1120, which is the standard federal form for corporations. Or you could file as a condominium homeowner association under Section 528, and you file form number 1120. And that is specifically for condominium and homeowner associations. There's no special election that has to be done or any forms have to be completed. The election is just made at the time of filing based on whatever return is filed. At this time, I'd like to do our second polling question. We'd like to see what type of return your associations are filing. So hopefully everybody, if you don't know, we even have a line for not sure. Okay. So let's go on. While we're waiting for the responses, we'll continue. Okay. Let's see. The responses are in, and overwhelmingly, the answer is not sure. So we have 1120, some 1120Hs, but overwhelmingly, most people are not sure. Well, hopefully, after tonight's webinar, you'll have gained some insight into the type of tax returns that should be filed, and this way you'll be able to understand exactly what your association is filing.
You know, Carol, I would add that for those board members who have some fiduciary responsibility, they might want to make it their mission to understand how the returns are filed and why. I just think it's an appropriate fiduciary duty on the part of the board to understand how the tax returns are being filed.
Good point, Ed. Okay, so let's talk a little bit about Form 1120 we'll start with. The concept underlying Form 1120 is that revenues and expenses are classified as either membership or non-membership. Membership income is monies received from association members. Anything that comes from a unit owner. Could be an assessment, late fee, membership fees, clubhouse rental income, pool fees, parking fees, anything that a unit owner pays is considered membership income. Now, if you're filing Form 1120, you would want to defer, and this is allowed what you're supposed to do, is you defer your excess membership income over expenses, you defer to the subsequent year, so it's not subject to taxation. So in other words, your membership income less your membership expenses gets deferred to the following year. So if that's done properly, then there'll be no tax on membership income. Non-membership income is monies that are received from non-member sources. So it's money that comes into the association that's from outside of the membership. Interest income from banks, rental income if the association owns a unit. If you're in a high-rise and you have roof space and you've rented out your roof to mobile companies, then there might be antenna rental income. Anything that's coming from outside would be considered non-membership income. And the association is taxed on the excess of non-membership income over any related expenses. Now, unlike membership income, non-membership income cannot be deferred to the next year. One other item, there is some non-membership income that wouldn't be considered as non-membership, and that is something such as an association receiving a reimbursement from a township. Although it's coming from an outside source, it's actually a reimbursement of expenses that were incurred by the members. So that does not go into the category of non-membership income and tax in that category. Now, some general guidelines. If you're going to file Form 1120 under Section 277, there's a certain number of guidelines that must be followed to be in compliance. The first is that you must make sure that, in fact, any excess membership income over expenses has been deferred to future operating periods. And we recommend that our associations file a surplus resolution that's done before the end of the year. If it's not done before the end of the year, then soon after. It should be done at a board meeting, and the board should vote on it, and it should adopt the resolution. And the resolution should be kept in case it ever comes up at a later date.
Carol, can I just jump in? I know that the actual revenue ruling that gave rise to this treatment of deferring the membership surplus called for that surplus to be carried over by a vote of the entire membership of the association. That's the revenue ruling. We usually see the boards doing it just as a practical matter, but we should all be cautioned that the actual revenue ruling that supports this was one where the whole membership voted on the surplus. And most of the communities we see are doing it just based upon a board resolution.
Right. Well, for practical purposes, it would be difficult to get the entire board. Another way to show that the whole association is also aware of this is that you want to include a surplus carryover in your budget for the next year. And this way it be communicated to all the unit owners. Another guideline that's really important when you're filing a Form 1120 is the guidelines that exclude replacement fund contributions from membership income. Specifically because of what we just spoke about in deferring excess revenues over expenses to the next year, replacement fund grows and grows so that monies are available for the replacement of property. Well, we don't want to include any of this replacement fund monies in membership income. In order to avoid that, there are certain guidelines that have to be followed. One is contributions to the replacement fund must be communicated to unit owners, and that is done primarily through the budget process. Contributions should be based on plans, and that is done primarily by having the contributions based on a valid current engineering study. Cash and replacement funds should be segregated from that of operating funds and labeled that way by the bank. And expenditures of replacement funds should only be used for the repair and replacement of common property. So as long as those guidelines are followed, then you're pretty much following the guidelines for treating replacement contributions as capital contributions and therefore not included in taxable income.
Carol, I just want to jump in for a minute because we did get a question as to whether these rules apply to co-ops.
These rules do not apply to co-ops. Co-ops file a different Form 1120C under subchapter 990T, under 990T. So the rules are different for co-op. The last general guideline to point out is that excess membership deductions may be carried forward to use in future years. So the surplus is carried forward, and if you have excess membership deductions, you may also carry them forward to use in future years. So just as a general question now, we've talked about the surplus resolutions. I'm just wondering how many of the associations that you're affiliated with do file surplus resolutions. So that's your next polling question that's up. When the results come in, then Ed will announce it.
While you're voting, just to clarify on the co-op situation, it's a different set of criteria. The distinction becomes patronage and non-patronage income, and it's a different scheme for taxation. Generally, if I were to generalize, most of our co-ops are not paying any kind of income tax unless they have some kind of non-patronage income, which would be something like antenna rentals on a rooftop or a commercial rental of a unit on the ground floor. But for the most part, the other sources of income typically taxed in a regular condominium or homeowner association are not subject to tax in a qualifying subchapter T co-op.
Okay.
Okay, we've got, looks like 40%, 47% said they did not file a surplus resolution, 26 said they did, and 26 said they're not sure.
Okay. All right. Well, as we said, it's very important to do. If you're not quite sure about it, then please, ask the management company. If they've received them, please call us. Call your accountant here at W&G and make sure that it is being filed.
In fact, if those 26% who weren't sure, if you should have filed one and you didn't, it should alert you to the fact that you ought to know whether you need one or not so you can do it if it's necessary. Otherwise, it does put you at a little more risk in your tax filing situation.
Okay. So if you have questions, please call your professional here at W&G. 1120H's. The concept in 1120H is income is divided between exempt function or non-exempt function. An exempt function income, it has to meet 4 tests. The first being a source test. The money must come from owners of units. The next is a nature. The amounts must be paid solely as a result of membership in the association and assessed ratably. If these are paid for a service or per use, it's not considered exempt function income, such as if there's garage fees that are paid on a usage basis, if you pay for pool admittance, laundry services, those things are not assessed ratably. The purpose, it has to be for qualified purposes, and qualified purposes is for the upkeep of the association. And the last is, it has to qualify and be considered under gross income in order to come into the test if it's exempt function. And under the 1120H in Section 528, amounts, certain things are not even part and considered part of gross income. So tax-exempt interest is not gross income, and capital contributions are not considered gross income. Capital contributions and replacement fund contributions. Now this is very important because when filing the 1120, we talked about that certain guidelines had to be followed for replacement fund contributions to make sure that they were not going to fall into the membership category and be taxed. Under filing the 1128, it's not even brought into play. It's not considered gross income. We don't even need to consider it in whether it's exempt or non-exempt. Now, non-exempt function income, and this is what's subject to tax, results primarily from 3 sources. It's revenue from non-association property. So that would be like interest that was earned on a bank account. Revenue for non-members' use of association property. If you have a rental unit, if you have guests that pay their own guest fees for pool, if people outside the community can rent your clubhouse, that's all revenue from non-members. And amounts charged to association members for specific services, which we mentioned a few before. Also, if you have laundry income, clubhouse rental income, anything like that, that would be considered non-exempt function income. So, and again, any income classified as non-exempt function income is subject to tax. Now, go ahead.
Just clarify, is there a distinction between membership-related income and non-exempt function income?
Yes. Yes. Well, membership income it comes from members, non-membership, not members. But exempt function income and non-exempt, you could have non-exempt function income that actually comes from members, and so some of that could be taxed. So there is a difference. The other difference is that the replacement contributions aren't even a thought and aren't even brought into play whether they're either exempt or non-exempt, because they're not considered part of gross income. Those are the two big distinctions. Okay. Now, in order to file Form 1120H, again, we're under Code Section 528, an association must pass the following 4 tests. Substantially residential. In other words, it has to be a residential association. 85% of either the units, the square footage, or the lots must be residential. 60% gross income test. 60% of the association's gross income must consist of exempt function income. Now, that's of the gross income, and remember, now we're not counting income that's not even part of gross income, such as replacement fund contributions. 90% of expenditures must be qualifying expenditures. That means it has to be for expenditures that are for maintenance and care and upkeep of association property. And lack of private benefit. We don't see this too much. That's where homeowners cannot receive distributions of earnings. Now, something to consider in here with this 90% of expenditures or qualifying expenditures, you're probably saying all the expenses of my association are for qualified expenditures. Well, the IRS has made the distinction that it's for the maintenance of association property. If an association sub-meters utilities and charges unit owners, they receive revenue from the unit owners, and then they pay the utility company, well, those expenses that are paid are not qualifying expenditures. And if they're large enough, they can kick you out of this 90% test. So that's something to be aware of and be concerned with. Okay. Now, for federal taxes, 1120 and 1128, expenses, we can allocate expenses that are generated in the production of income. So you want to take a reasonable estimate of expenses that were incurred in generating the income. So we have another polling question, and that's the type of income. I think your question is showing up. What are your association's major source of income? So we'll take a look at what kind of income that associations need to be concerned on. I'll continue. When the results are in, it'll give the result. Federal taxes, the rates under an 1120, the regular corporate rate starts at 15% and increases to 39% based on the level of income. Under an 1128, the rate is a flat 30%.
Okay. Let's see what the answers are.
Okay.
Primarily interest income. 94% is interest income, and 6% are utility pass-throughs.
Okay. Now, so now we've talked about the different.
Just looking at that, what's the effect of a utility pass-through when you want to file an 1120H? Is there a significance? Is 1120 under the 1120H? If you have a large amount of utility pass-throughs, does that impact whether you can file an 1120H or not?
Yes. If you have that, if the utility pass-through, if the revenues are not qualifying and the expenses paid to the utility company are not qualifying. So
I guess that assumes it's sub-metered.
Yes.
They're sub-metered as opposed to doing it in the percentage interest formula. If it's sub-metered, if
it's sub-metered, they take the position that that really has nothing to do with upkeep of association property. Okay. Now we want to say, okay, well, what do we file? So we know we have 2 options. Of course, you want to file the return that gives you the lowest tax, but you can't look at that in a vacuum. Usually the 1120 will give you the lowest tax, but If you have a high accumulated surplus and you didn't meet the requirements for deferring revenues from one year to the next, then perhaps membership income could be taxed. Well, then you'd want to file an 1128 because there's no concerns about surplus carryover. If you're not meeting the guidelines for excluding replacement fund contributions for membership income, well, then again, you might want to file an 1128. If you have high amounts of income that are not assessed ratably, then you might want to file the 1120. And just to give you an idea, the rates even out at about $186,000 of income. Up until $186,000, it's less expensive to file an 1120. If you have greater than $186,000 of taxable income, it's better to file an H. Just some special areas of concern. Tax-exempt interest, it's tax-exempt, same as it would be anywhere else. You're not paying taxes on it either under 1120 or 1128. Capital losses can only be used to offset capital gains, so that's something to be concerned about. If you have capital losses, you want to have capital gains to use that up.
We might want to add that there is no special capital gains rates. The capital gains are subject to ordinary income tax rates for the 1120 as compared to the way you treat it personally.
And last, if you have various non-membership activity, you can offset the gains and losses in those categories. Just quickly to let you know, federal tax payments, a lot of the associations are using the coupons, Form 8109, to deposit their taxes. The IRS is changing these rules, effective in 2011, and although the rules are not yet out, banks are going to not longer be accepting the Form 8109. And we recommend that you go and register online, if you haven't done so already, to www.eftps.com so that you can have direct payment of your federal taxes. Lastly, state income taxes. So far, New Jersey is not taxing condominium homeowner associations. They're filed under Title 15A of the statute. There's no return to file, no tax to pay. Unfortunately, co-ops aren't quite as lucky. They must file a New Jersey state return, and at a minimum, they have to pay the tax on New Jersey on gross receipts. Well, that's the end of the program on taxes, on income taxes. I'm going to now turn the program over to Vinay.
Thank you, Carol, and good evening, everyone. We're going to talk about the exciting subject of sales taxes in New Jersey, and I believe we have a polling question now. And since most CIRAS are established as New Jersey nonprofits, are they subject to sales tax? Or they're not subject to sales tax, true or false? So while, well, I need to wait for that because the next slide is going to give away the answer.
Okay.
And the answer is false. Okay. In New Jersey,
That was a good response. We've got
exactly.
a good group here.
We have a good group. In New Jersey, there's a tax of 7% imposed on sales of tangible property, and the way the law works is taxes imposed on the sales of property unless there's a specific exemption in the sales tax code. When it comes to services, however, services are not subject to sales tax unless the service is specifically mentioned under the statute. There's often this misconception that CIRAS are not subject to sales tax due to their nonprofit status, but they are very much, in fact, subject to sales tax.
Vinay, do you have a couple of examples of services that are taxed and those that aren't?
In the world of CIRAS, we're going to get to them, but membership fees, storage fees, things like that. Outside the world of CIRAS, certain types of
Or accounting fees subject?
accounting fees are not subject to sales tax.
All right. Everybody hear that? Or attorney's fees?
That's correct. Most professional services are not subject to sales tax, management fees. So now we'll go to the mirror image of sales tax, which is called use tax. Now, the rules are exactly the same for use tax as they are for sales tax. The same types of things that are subject to sales tax are subject to use tax. The difference is who's on the hook. In use tax, the buyer or the service recipient is on the hook. if I'm purchasing goods and they should be subject to sales tax, but for whatever reason that seller doesn't charge me tax, the responsibility shifts to the buyer to collect to pay the use tax. It's a sleeper for many taxpayers, not just CIRAS, but for businesses in general. And during New Jersey tax audits, this is where they really focus in on the use tax. So we pay particular attention to use tax. So let's go to sales tax areas that we commonly see for CIRAS. And before we talk about that, let's put this into context. Because many of these items we're going to talk about, the law is not 100% clear, or there could be different interpretations. As a CIRA, the conservative answer is to collect and remit the sales tax at the time of the transaction. Now, no one wants to pay sales tax if they don't have to, but the alternative is the state coming in 2, 3, 4 years later and finding that a transaction was subject to sales tax. Now, that becomes a real expense of the CIRA when it would have otherwise been passed along to the person who really got the benefit. So there's kind of a double-edged sword with how aggressive a CIRA wants to be when it comes to sales tax areas.
And it looks like at this point you're jumping into the area where the CIRA is performing services and collecting revenues.
That's
as
correct.
Opposed to incurring expenses for which there may be sales tax due.
Correct.
This focus is, right, for this slide is on monies they're collecting and services they provide.
That's correct. And that's why if a CIRA were to take the position that they were not subject to sales tax and the state were to come in, the cost associated with these transactions would fall on the CIRA when they would otherwise be paid for by the residents. So if we look at some of the most common areas, health and sports club membership fees, storage units, and parking are things that we see a lot. So let's go into each one in detail. Health and sports club membership fees. The general rule is typically this relates to things like pools, gym memberships, and golf clubs are probably the three most common areas that we see them. Now, if the use of those facilities is included in part of the monthly maintenance fee, then it's not subject to tax. That is very clear. If membership is optional, however, and the resident has to pay something extra, let's start with the assumption that that amount is subject to tax because it looks and smells a lot like a membership fee. Now, one of the primary exceptions of the law is what they call the participatory sports. If I can go and pay a fee on a per-use basis to use a facility for an athletic purpose, swimming, working out, playing golf, that fee is not subject to sales tax. Now, the next screen is a lot of words, but they're very important. There is an exception for something called the season pass. We see this most often with golf clubs. And what the state says is that if I can go and go to a pool and swim once for $10, or I can buy a season pass for the summer for $200, if I meet this definition of season pass, then maybe this is not subject to the tax and membership fees. And you can read the text, and I'm going to read it because it is important. A business may sell season passes which entitle the purchaser to a reduced rate, but not to any right, privilege, or entitlement not also available to the general public. The charge for the season pass is not a membership fee since it merely allows the discounted rate which the general public is also entitled to. The only advantage of a season pass is economic. The key here is the general public. Most CIRAs, if they have a pool or a gym, are not going to allow members of the general public to use that. So it kind of takes the season pass option off the table. What we do see is golf clubs, CIRA that will have a golf club, will allow the general public to golf there. And there are golf clubs that will structure their membership is a bad word, structure their admission as a season pass to enable the fees to otherwise be not subject to sales tax. And it's a very tricky situation because you have to make sure that the person who's buying the season pass has no better rights than somebody who's paying a per-use fee. So again, it is something we usually see in golf clubs, and it's very important to stick to these rules.
Can I just jump in? I know that there was a recent case where the state was examining a particular golf course on this this particular issue of whether the rights and benefits of the season pass holder were the same as the one-time user of the one-day pass as opposed to season pass. And I think in that case what the agent discovered was that the season pass holder had some other rights that extended beyond what the one-time player got. For example, they got some benefit of certain playing times that they could play or pre-register for tee times. And the state actually scrutinized the website of the golf course to find out whether, in fact, those season pass holders got benefits that went beyond what the individual day pass holder got. And in that case, they found some subtle differences, and they subjected them to sales tax.
Which is consistent with the last bullet here, that the marketing is very important here, because the state does look at those advertising type of materials.
Renee, we had a question here about whether guest pass is sold to outside guests are subject to sales tax.
Does it say what the context is?
It says is guest passes sold to members for bringing in outside guests to the swimming pool subject to sales tax?
There is an exemption for guest passes in the law, so that should not be the charge associated with those guest passes should not be subject to sales tax.
And again, if it's to the pool, it's a participatory sport in a sense, so potentially one-day pass is not at risk.
Correct. Correct. Okay, so let's go to parking, which is another area that we see. The general rule is that parking fees for residential parking are exempt. That seems cut and dry. Where we get into some unclear aspects is if there's a guest parking fee and it's paid for by the guest, that probably doesn't fall under this exemption. Some CIRAS will have valet parking services, and again, those probably fall outside that exemption and very well could be subject to tax. We don't have any clear guidance on those, but those are the areas that we're kind of alert for. Now, many CIRAS will have storage units in some common area, and there will not be a storage unit associated with every residential unit, but there'll be a smaller number, and a resident can go and rent one of these storage units pursuant to a separate lease, sometimes on a monthly basis or an annual basis, and that will be a revenue stream for the CIRA. Now, back in 2006, the rental of storage units became subject to tax, and the way the law is worded, it's really focused on people who are in the business of renting storage units. And when this law came out, it seemed as if CIRA should not be subject to this rule because the rental of a storage unit is really incidental to the purpose of a CIRA. A CIRA cannot be compared to the self-storage unit on the side of the road that you can pull your truck up into. We're aware of at least one situation where the state has taken a different position and consider that subject to sales tax. So the jury is still out on that, literally, but it's something for a CIRA that has a large amount of rental income from these storage units to really be cautious of and to think about carefully. Now, the next area that we see sales tax come up is in-unit repairs. Now, some CIRAs will have their own staff on grounds and will perform services, maintenance services, or repair services for residents and charge sales or perform the service and charge a fee just like any other contractor. Well, in those cases, the CIRA is the contractor and is subject to the same rules that any repair person or maintenance person will be subject to. And we'll get to it in more detail later in the program, but the CIRA's got to charge sales tax on the service. When they buy their parts, the CIRA has to pay sales tax on the parts, and when they render their invoice to the resident, they should separately state the parts and labor, and in that case, they don't have to charge sales tax on the parts, only the labor. And it's an often overlooked area by many CIRAs that do this kind of work. And we have sales tax on labor only, And I think we have a polling question now, just to get a sense as to how many of you have in-unit repairs in your association. And we're waiting for the votes. And we have
Yes, 35% and no 65%.
All right, so more yeses than I would have thought.
Yeah.
Interesting. Let's talk just very briefly about the New Jersey Enterprise Zone rules. There are these New Jersey Enterprise Zones set up all over the state. They are a whole basket of economic incentives designed to encourage economic growth in certain areas. The principal one that most people are familiar with is a reduced sales tax to 1/2 the normal rate of 3.5%. There's many other benefits. There's income tax benefits and credits and other subsidies available. There are very strict rules to get these benefits. For example, if you happen to be in an enterprise zone and you're buying goods from an enterprise zone, the purchases have to be done face to face. You can't just call up a paint vendor and say, send me over some paint. We're going to, we need it. Some of the areas of UEZs in the state, I've listed them there. There's others. The real resource is the state's webpage. Has a tremendous amount of information about New Jersey enterprise zones if you happen to be an association in an enterprise zone. And I think we have another polling question. Okay, so this is really setting us up for the next set of topic we're going to discuss, which is on paying. Can you avoid paying sales tax by purchasing goods from out of state? Yes or no? Or true or false? And the answer is false. Okay.
Good group.
That's correct. Now, use tax concerns. Out-of-state purchases are number one. Some of the other things we're going to talk about are repairs, installation, maintenance, landscaping, and capital improvements.
Renee, what was the reason the state came up with this use tax system?
Because just think about how easy it would be to order something in the mail and have it shipped to you, and the out-of-state vendor would have no connection to New Jersey, no responsibility to collect New Jersey sales tax, and the state was losing out.
Right. Plus, I think it gave out-of-state vendors an economic advantage over in-state vendors.
Correct. Correct. So, and in the world of the internet, that tension has only increased. So, out-of-state purchases is obvious. What we often see in this area as likely suspects are office supplies, pool furniture, and other are the two things that we see a lot of from purchase from out-of-state vendors for which no sales tax is charged. Let's talk about this whole basket of services called repairs, installation, maintenance, and landscaping. These services are subject to tax. And if the parts are separately stated on the invoice, then there's only tax on the labor. If the parts are not separately stated, the entire invoice is subject to tax. Now, this is something we see a lot of non-compliance in among vendors. Typically, when you have smaller service providers, they tend to be not as focused on the rules and sometimes fall into this trap of thinking that a CIRA is tax exempt and therefore no tax is due. And when that happens, now we have a use tax obligation on the CIRA. Now, at one end, we have a repair. On the other end, we have a capital improvement. When real property is purchased, there's no sales tax. So by extension, if I have an inherently permanent type improvement or addition to real property, that shouldn't be subject to sales tax either. So that's what the capital improvement rule tries to do. And we put the definition on the screen. It's an inherently subjective definition, and it's a frequent area of disagreement between the Division of Taxation and taxpayers. And as an example, if I have a hole in my roof and I have attached that's a repair. If I have an entirely new roof put in, that's a capital improvement. Now, there's a whole lot of in between a patch and a new roof, and that's where this gray area comes in between what's a capital improvement and what's a repair. If something constitutes a capital improvement, the CIRA pays no sales tax on parts or labor. And two main exceptions to this general rule are flooring and hardwired security systems. To take advantage of the capital improvement, the CIRA has to issue a form called an ST8 to the contractor that the CIRA is going on record and saying, we believe this is a capital improvement, and that takes the contractor off the hook from charging you sales tax. Now let's talk about the filing requirements for...
Hey, can we just go back one
Go ahead.
question?
Sure.
With respect to those capital improvements, what does the contractor pay sales tax on when he purchases the goods and or the tangible property he's installing?
That's a great question. The contractor will always pay sales tax on the materials. Think about it this way. It is impossible to go to Home Depot. It's not impossible, but almost everyone at Home Depot who buys something is going to pay sales tax at the cash register. So whether that person is the end user or the contractor, someone is always paying the sales tax. And if I'm the contractor, I'm going to pay the sales tax. I'm going to build it into my bid price. But I, the contractor, am the one responsible for remitting the sales tax, not the end user. Okay? So now that we've figured out what's subject to sales tax, what our use tax obligation is, how do we get this money over to the state? Well, with one exception, it's all electronic. It has to be done online. And the key criteria is, do I have a monthly liability of greater than $500 or less? If it's greater than $500, I have a monthly filing obligation. If it's $500 or less, I have a quarterly obligation. And if I meet the criteria of no sales tax is due, so that means I only have use tax, and my average use tax for the last 3 years is less than $2,000, I can file an annual use tax filing, a Form 18B, which is a paper form. It's an important form, and we're going to come back to it in a moment. So now let's talk about some of the best practices for CIRAS in the sales tax arena. Every invoice should either have sales tax charged or documentation as to why no sales tax was charged. And if no sales tax was charged, and there should have been, use tax should be paid. If required, file your sales tax returns online to the Division of Taxation. And if no sales or use tax, still file a Form ST18B, the annual use tax return, even if nothing is due. And the reason why we do that is by filing that form, even with zeros on it, it starts the statute of limitations with the state. If you don't file that form and you're selected for audit, the state, in theory, can go back forever. As a practical matter, they usually go back about 7 years. But if you've been filing that Form 18B, you're generally limited to a 3-year look-back period. So it's something we strongly recommend for CIRA and just general business clients. In the world of capital improvements, carefully look at the nature of the project. It's very tempting to just say that, yes, this is a capital improvement and not pay the tax. But think about how an adverse party would look at this and consider how strong your argument is that it is a capital improvement. If it's unclear, think about keeping those funds that you have otherwise paid in use tax in reserve for some period of time, and you can seek written guidance from the state. And depending on the outcome of that guidance, you could remit the tax late, you would have interest and penalties, but at least you wouldn't be out of pocket, you would have budgeted for the money. Keep your ST8s on file, and keep everything you can to support the capital improvement treatment if you're audited. Things like blueprints, permits, anything to really drive home the fact this is an inherently permanent project that you've worked on.
One of the things just to point out in keeping the invoices, I know typically when the state comes in and audit, they'll pick a sample period.
That's correct.
And if it happens that your sample period has more than the average number of missed items for sales tax, your audit may end up resulting in a greater tax due. So if you think that's the case, it makes sense to have all these back invoices to prove to the auditor that the period they picked was an aberration and you really may have a lower amount.
That's an excellent point.
And you don't have to volunteer it if it goes the other way.
And that concludes the sales tax portion of the presentation. We're going to talk just for a moment about the energy tax credits. And actually, I'm probably just going to illustrate the fact that there's more unanswered questions in this area than there are answers. You know, we all hear about solar energy and the big tax credits that are available, and the credit is based on a percentage of the total amount spent for the types of investments. Now, the tax code has a special rule for CIRAS, and it says that if the CIRA spends money on solar or other energy improvements, it's treated as if the resident paid for their respective share of that expense. And in a sense, that is a good rule because CIRAS generally don't have a large tax liability, so that tax credit will get wasted. So what happens is the credit goes to the residents, not to the CIRA. And that's good and it's bad. It's bad because the CIRA is the one that funds the cash outlay for the solar panels, and the credit goes to the residents. There's often a mismatch between the tax benefit and the expense, and it makes the financing just much more difficult. There's also, because you have references to dwelling units in the tax code, most CIRAs are interested in putting solar on a clubhouse that really wouldn't be a dwelling unit. And there's an unanswered question as to if the solar panel is put on a non-dwelling unit clubhouse, does it get passed out to the residents in the same way? The other area of uncertainty is that most private businesses are eligible to forego their tax credit and get a cash grant from the Treasury. It's just unclear at this point if a CIRA would qualify, and there doesn't seem to be a way to get advance ruling from the Treasury for a CIRA to find out if they're going to get the cash, and the dollars involved are too big. So we hear of a lot of interest among our clients, but very few people, if any, have really pulled the trigger on making these large-scale alternative energy investments.
Just to throw in, the other moving part to this is the actual economics of the transaction. And one of the biggest components to make this an economically viable alternative, putting aside the desire to be green, is whether it makes economic sense. And one of the big components to that analysis is something called an SREC credit, which is a credit that the state of New Jersey provides for these kind of investments. So as you look at solar, you have to understand the economics and some of these other moving parts to know whether, besides the tax component, whether it really makes economic sense.
And maybe when we get some real answers on that, we'll have another webinar on energy. Okay, so we're going to wrap up with a very, one last topic on Form 1099 reporting, because it is important. CIRAS, like any business, must issue a 1099 for any non-corporate recipients who receive $600 or more for services. What's a non-corporate recipient? As a practical matter, it's somebody who does not have an Inc. or Corp. in their name. And if the payment is to an LLC, chances are that probably the better answer is to go ahead and issue a 1099 to the person who you either paid individually, or if they have LLC or company or something like that. They don't have, as long as they don't have Inc. or Corp., you're better off sending a 1099. One exception to that Corp rule is that 1099s always have to be issued to a law firm, even if the law firm is incorporated. Forms have to be sent to the recipient by January 31st, and they're due to the IRS a month later. Now, that's the rules as they exist right now. Starting 2012, these rules are expanding significantly to include purchases of all goods, not just services, and they're removing the corporate recipient exemption. And there's actually a lot of discussions among business people in Congress to repeal those rules because they're supposed to be very onerous. But just keep that in the back of your mind that right now, if nothing changes, these 1099 reporting rules are going to become much more complex and voluminous in a few years. And I think the moral of the story here is that when you start to do business with a new vendor, get their tax ID information so you have that in advance, so you're not scrambling in January to try to get that. It's amazing how many phone calls will go unanswered in January when you're calling people to get their tax ID numbers.
Yeah, don't give them the money until they give you the number.
That's right. That's a very good point. And that brings us to the end of the formal part of the presentation.
Okay, we have some questions. I'll try to jump on the ones I can here. First one, if valet parking is available to all unit owners at no additional cost, is it an issue? Is it an issue in terms of sales tax? This is the co-op.
Okay. My guess is probably not if it's available to all unit owners, because the state usually on a variety of different types of transactions will take the position that if something is part of a maintenance fee is not subject to tax. It's only when you start paying separately for these types of services is there concerns about sales tax.
Okay. Let me see what else we have here. What capital expenditures do CIRAS most often pay sales tax on that is not really due? What's a typical? What are some of the problems we see in terms of sales tax?
Where it's paid, where it wasn't due?
Yeah.
I'm not really, I think it's more, CIRAS are pretty much,
capital improvement stuff.
yeah, whether it's a repair or capital improvement, whether it could have been, you could say it's an improvement versus a repair. There's some roof repairs, and maybe the case could be made that it was an improvement. That would probably be the only area.
Yeah, that's the only area that I can think of off the top of my head.
Okay, here's a good one. If my association is in a UEZ, Urban Enterprise Zone, does that mean we only charge our members 3.5% for in-unit services?
That's a great question. I don't want to hazard a guess because the UEZ rules are very complex. So we'd have to check that out and get back to that.
Maybe you can email us, and we'll get back to you through email.
Okay. I think that's it. Those are the questions, and we're out of time. But I thank all of you. I thank our panelists for speaking, and I thank all of you out there listening, participating, and being part of the polling questions. And as always, you see the contact information up on the screen right now. Please feel free to email us or call us here at any time with any of your questions. We'll be happy to answer them. And we'll keep you on the list for our next webinar. Don't forget December 9th for clubs, and we will be having these regularly throughout the year. So thank you all, and have a good evening.